fine. So I will hand over to James now to get started.
Awesome. Thanks very much. Hello, everybody. Thank you very much for taking some time to come and listen through today. It's a good webinar. We've got a lot of data. We are going to look at a few things, including specifically what's going on currently with retail economics, obviously COVID and post-COVID, looking at the macroeconomic trends outside of retail, which of course have an impact on retail too. We'll be looking at consumers in crisis. We'll be taking data from consumers in previous recessions, seeing how they behaved and what the behavioral changes were. We'll also look at companies in crisis. We'll look at data from companies in previous recessions. Then we'll think about how to thrive, changing your mindset, looking at the different mindsets that exist in retail and the opportunities online that even online pure plays might not be fully making the most of. And finally, we'll finish on how to adapt. 3 rules, how to execute progressive change. So looking at what categories have obviously benefited most, I think this is probably not new information to anybody on this call because they've probably seen 100 articles now about which areas of e-commerce are booming. It's seemingly worked in a sort of sequential manner. Obviously, there was the initial staples food, panic buying. Then there's been moves through fitness, home gym equipment, office equipment, and now sort of starting to normalize a bit more. There have obviously been some losers, especially in the fashion arena, less outfits to go out. We actually have a client in the costumes and party supplies vertical, and it's a really bleak picture for them, unfortunately. But it's fairly obvious why e-commerce is exploding right now. More people are online and stores are closed. So let's take a look at the macroeconomic scenario. Obviously, everything shut down in China, followed by Europe and finally the US. Stock markets collapsed, although there's been an absolute resurgence in recent weeks, although we don't know how that will last. Definitely a lot of uncertain outcomes. It's possible that we'll have ongoing intermittent lockdowns and potentially a second wave. So economies are at a virtual standstill. Travel and oil prices have collapsed. Corporate liquidity risk is very high. Even the US have now opened up the bailout of private debt, or junk bonds, I should say. And contagion is definitely spreading through different markets, including into retail, which is having a knock-on effect into finance. And of course, the economy being what it is, that is going to impact retail, consumer confidence, business confidence, spending, investment. There's of course been some government stimulus. I suppose the question is, will it be enough? Will they need to do more? And for the recovery, there's been a lot of conversations about what type of recovery we might get. Will it be a V-shaped bounce? Increasingly, the consensus is this is not going to be the case. A lot of the early government stimulus has actually meant that we've probably just kicked the can down the road a bit. We're probably still covering up some of the cracks that have emerged in the economy, and it is likely to be a very drawn-out, muted recovery. So this is looking at some data from McKinsey, who played out the potential recovery. The pale blue line is the Eurozone. The black line is the US. And obviously they see China faring a bit better, but things are not looking so good for the rest of this year for the West. The crisis does not end with COVID. Economies will struggle to get back to normal. Consumer behavior will be different. So must business models be. Consumers in crisis. Behavioral change in recession. Physical retail contracted 35% more than online retail did during the GFC, or the financial crisis of 2007 to 2009. This time, the figures will be more extreme, obviously, because physical retail has had to close entirely. This is some data taken from a survey that looks at why people shopped online during the GFC, 2007 to 2009. The number one reason that people shopped online during the last financial recession was purchase confidence and comparison. The number two reason was best deal assurance. The number three reason was searching for online discount codes. And the fourth reason was to save money. Millions of first-time online buyers are materializing for certain products. Millions of infrequent buyers are now doing so on a weekly basis. This data looks at online grocery shopping through March, with the red bars looking at the proportion of shoppers who are shopping for groceries online more than they were before. So you can see that it's obviously growing week on week. But these are not new trends. COVID has simply accelerated existing trends. Over the last 4 years, you'll notice that purchasing groceries online has grown year on year. But habits tend to form and stick during periods of uncertainty. Smart businesses are now creating footholds or deepening them. So let's take a look at companies in crisis. Here we're going to look at data from companies in previous recessions. This data is all taken from Harvard Business Review. Harvard Business Review did a study of 4,700 companies across 3 different recessions. The recessions of 1980, 1990, and 2000. And here are the results. 17% of companies do not survive a recession. 80% of companies do not regain their pre-recession growth rates for both sales and profits within the 3 years following recession. 40% of companies do not regain their absolute pre-recession sales and profits. Just 9% of companies flourish after slowdowns by outperforming rivals. And again, you've probably all seen lots of articles that say, spend more on marketing, even in a recession. So let's dig into the data around this a bit more. How marketing in recessions impact profits during the recovery. Well, here's the data from 2007 to 2009 recession. Companies that invest in marketing saw a 4.3% increase in profits during the recovery, as compared to a negative minus 0.8% for companies that did not. And if we look at a different recession, 1920, we can also see that the sales index for companies that increased advertising significantly outperforms those that decreased advertising. But it's not as simple as simply increasing advertising or cutting costs. In fact, 79% of firms that cut costs faster and deeper than their rivals do not perform better coming out of a recession. 74% of businesses that invest more than their rivals do not become market leaders coming out of a recession. 85% of market-leading companies before a recession will not stay there. They will not be leading their market thereafter. So it is obviously a time for acquiring market share. The Harvard Business Review study breaks up companies into 4 different types. You have prevention-focused companies who cut costs. You have promotion-focused companies who increase spending on advertising. You have pragmatic companies that do a balance of both, but perhaps a suboptimal balance. And then you have progressive companies who manage the optimal balance of cutting costs and increasing investment in the right areas. So let's take a look at the relative performance between promotion-focused companies that simply increase their advertising and progressive companies who both optimally increase their advertising and optimally decrease investment in underperforming assets. You'll see that the progressive companies see a 13% increase in sales as compared to just 8% increase in sales for promotion-focused companies. And profits-wise, progressive companies see a 12% increase as compared to a half that for promotion-focused companies. So let's look at a real-world example, specifically looking at the 2000 recession. Here we have the performance of Office Depot and Staples. So Office Depot cut workforce by 6%. Staples increased their workforce by 10%. Office Depot couldn't reduce operating expenditure. Staples contained OPEX and closed down underperforming facilities. Office Depot introduced an incentive plan to boost sales. Staples adapted and they introduced high-tech product categories and services. Office Depot's sales growth fell from 19% before the recession to 8% thereafter. Staples' growth of 13% coming out of the recession, a whole 5% higher than Office Depot's. Office Depot's absolute revenue increased 50% between 1997 and 2003. Staples, for the same period, saw a 100% revenue increase, and they were 30% more profitable than Office Depot in the 3 years following recession. So how to win? Well, this data is taken from Forrester's Customer Experience Performance Index for the recession of 2007 to 2009. And it looks at the top 10 companies in the Customer Experience Performance Index as compared with the bottom 10. The bottom 10 can be seen by the black line, the laggards, whereas the top 10 can be seen with the blue line, the leaders. And there's proof here that by focusing on customer experience, these companies outperformed companies that did not focus on customer experience by 3 times in terms of absolute returns for shareholders. So it's clear that addressing customer needs is a way to prepare for the future. And if you start to look through changing customer behavior or changing customer requirements, then this is the perfect lens to prepare. So let's think about some ways that we can address new customer needs. You can optimize the stock that you have on hand. You can optimize your inventory allocation, and you can ace digital product discovery. Why is this? Well, it's not just through COVID that shopping online is going to remain prevalent. Even as lockdowns ease, there will still be restrictions on people going back into stores, and people may be averse to crowded areas. So it's important to get your online product discovery absolutely spot on. And it's also important to make sure that you localize your demand data. Localize your demand data and ensure that you have the right stock available at those stores, especially if you're going to be looking at things like buy online, pick up in store, click and collect, curbside pickup. You need to reimagine the current world. So you need to be shrewd and obviously enact cost cutting. And it's very likely at this stage that many retailers have already gone ahead and cut what they can in terms of underperforming assets. You need to really focus on migrating consumers to digital channels. Now, naturally, they're going to be doing this, and naturally, it's going to be more competitive. So, of course, you do need to increase your advertising spend. Now, moving people online is actually going to save you money and boost satisfaction. And finally, you need to build agile capabilities. You need to be focused and acquire market share in this time. You need to adapt business models to accelerate growth post-crisis. And you need to invest in machine learning and intelligent ways to automate your data workflows, your stock reallocation, your product discovery and customer experience. So following on from that, how to thrive, changing your mindset. There are 2 mindsets in retail today, one of scarcity and one of abundance. Scarcity mindsets are focused around rental cost of shelf space. Abundance mindsets consider the low inventory costs through warehousing and even third parties. Scarcity is looking at things like limited space, whereas abundance mindsets think about things with an infinite space. You're starting to paint a picture here of your physical only retailers versus your hybrid and online only retailers. Those physical retailers in the scarcity mindset have to sell bestsellers. They only have finite shelf real estate, whereas online retailers can pretty much sell everything they want. Scarcity mindsets, as a final point, suffer top-down hierarchies, long decision processes for ROI forecasting and approval. Abundance mindsets are able to be agile. They're able to experiment and learn. And their hierarchies are bottom-up, not top-down. I don't necessarily mean from the most junior person on the marketing team. I mean from the customer. These companies are data-driven. Everything they do is orientated around data. So let's start to think about the balance between physical assets and digital retail. Well, physical channels were far from perfect. They were opinion-led or blind on inventory, which meant that they had to stock the lowest common denominator items, i.e. those that they expected to be meeting popular taste. With that came assumptions around popular taste, and often would be subject to poor supply and demand matching. How often has something been out of stock in a store that you've wanted to go in and buy it from? Whether that's size depth or the item itself. Physical stores are pretty high cost and therefore they're pretty high stress. They're also relatively low risk and relatively low return. You have the rental costs and the cost of serving walk-ins. Every item that you stock on a shelf has to earn its keep, especially if you're in an expensive, high footfall retail unit. That finite shelf real estate means limited ranges. So physical retailers were forced to have a reliance on bestsellers, and there is nothing wrong with bestsellers, but everybody's taste departs from the mainstream somewhere. The more we explore alternatives, the more we are drawn to them. But don't take my word for it. Here is the share price data for Shopify in black, Amazon in orange, Boohoo in blue, as compared with Sears, red, and Walmart in green. Companies that have been slow to go online have not been competitive with those that have been fast to grow online. In the US, UBS expects 100,000 stores to close in the next 5 years, and it expects massive consolidation for the big box retailers. It says in its study, coronavirus pandemic to have a long-lasting impact on the retail sector. The analysts expect the effects of the pandemic to accelerate a trend that was already in motion. The fundamental reason for stores closing down in the future will be the rise of e-commerce. UBS expects that many people will not go back to stores, or at least will limit their visits. This isn't only because of new habits put in place during the pandemic, but also because there's likely to be a lingering fear around going to crowded spaces. So let's go back to these mindsets. How can we think about products with the abundance, the long tail mindset, against the scarcity, the short tail mindset? You can think of all of your products along the x-axis, individually representing the sales volume that each product might have. The y-axis is that sales volume. So a store like Sears would have to depend on bestsellers, popular items, high sales volume per item options. But because of that, they're missing out on sales volume that can be double what they're used to selling through bestsellers in store. And that is the long tail. The items that are slightly less popular, increasingly less popular, but each having their niche. Spotify with 35 million songs, Netflix, Amazon with 350 million SKUs have all managed the long tail sales opportunity very, very well indeed. So let's now think more about the benefits of selling online. Cost savings. You've got these big out-of-town warehouses. You've got no cost of walk-ins. You've got your long tail revenue. You've got this unlimited product catalog. You can serve more niches. You have a higher likelihood of converting a visitor because you're able to have more items that might meet their requirements. And you can have a more consistent, a better customer experience. You're able to provide things like search, reviews, product recommendations. You can provide consistent and intuitive convenience, something that's very hard to keep up in store. And the long tail profit opportunity is bigger as well. I mean, the profit threshold for physical retail is a lot higher, so things have to be more expensive. For items into the long tail, the profit threshold comes down. The more you can diversify your assets from prime real estate and high footfall retail units, the more you'll be able to play with that margin and be more appealing to price sensitive customers. In fact, you can start to look at tiered pricing strategies and long tail item recommendations. Tiered pricing strategies and recommendation engines can drive customers to product they may not have found otherwise. You can start with the best sellers, but then you should allow discovery of items into the long tail. So as a final section, we're going to look at 3 rules. These 3 rules are how to execute progressive change to future-proof your e-commerce. Your long tail market potential is twice the size of your best sellers market. Here are the 3 rules. Make everything available, get smart on pricing, and help me find it. What do I mean by make everything available? Well, you can stock more style variants. You can be selective. You still need to be selective, but you can be selective about more things. You need to use the data that you have to inform stock depth and product assortment. Get smart on pricing. You can forget about channel conflict because online should be cheaper. People do buy more at lower prices, and long tail items, so slightly less popular items, actually cost less anyway. And finally, help me find it. Do not become a mess of bad products. Lead with best sellers from which further exploring can begin. Guide consumers based on their likes and dislikes. Remember why people shop online during a crisis and shape your strategy around these facts. Purchase confidence, comparison, best deal assurance, save money. Rule number 1. Okay, so what do we mean by make everything available? We mean this both in terms of item availability and stock availability. 87% of shoppers start their journeys online. And that statistic is from pre-COVID, so it's obviously higher today. What are you doing with all that demand data? Consumers want to buy, receive, and return goods anywhere. So if you are not using localized demand data from your website to inform your order management systems, your stock allocation systems, your inventory planning, and your buying team and design decisions, then you are missing a huge opportunity. You can use that online demand data to optimize products and your online journeys, your in-store journeys, and most importantly for the post-COVID world, online to in-store journeys. In fact, buy online, pick up in store shopping has increased 62% since COVID kicked off. Data's from the US. You've even got innovative approaches to curbside pickup of drive-through retail. Before COVID, 67% of shoppers had used buy online, pickup in store. And 88% of retailers were actually able to track incremental in-store purchases from their BOPIS customers. Plus, retailers can save on shipping costs and cut down on fulfillment times through inventory allocation optimization to permit shipping from store as well as store pickup. So whether you're doing buy online, pickup in store or looking at ways to reduce fulfillment times and shipping costs, optimizing your inventory allocation is going to be key to doing that. In fact, $24 to $30 billion a year of Amazon's retail sales in the US are attributed to consumers who first tried to buy items in a physical store, but that retailer was out of stock. That is 21 to 24% of Amazon's sales stemming from challenges in inventory management, because most retailers are not using their online demand data as a proxy to help inform store demand. So you need to start thinking about how you can localize every single page view, every single product view, and research session and search. And that's something that we can help. Rule number 2, get smart on prices. Increase sales, cash, and earnings with intelligent and dynamic pricing. Your pricing strategy needs to think about recommended retail price and, of course, your profit margin. But you can also crawl competitor sites and have an understanding in real time for each different SKU about the price in market. And you can then use that data, working within the margin that you need, to enact pricing strategies across tiers. You can pull customers down the long tail of items with lower prices the further down they go. And as mentioned before, long tail items actually cost less, so you can charge less. Since most long tail of items aren't actually available in store, channel conflict actually diminishes. So something that we do is we develop AI-based pricing models that use a mixture of things like interpreting where an item sits in the long tail. We look at competitor prices for our competitive response module, and we look at optimizing per item based on price elasticity, how a product's price affects demand and price perception or conversions. Now, these dynamic prices can be on qualifying items only, i.e. your less popular items or your overstocked items. But they can also be enacted as SKU level incentives rather than dynamic prices. We're not talking about site-wide blanket discounts. This is exactly what we're trying to get away from. And finally, rule number 3, help me find it. Great long-tail businesses can guide consumers following their likes and dislikes. If you like that, then you'll love this. Just as lower prices can entice customers down the long tail, recommendation engines drive them to products they may not have found otherwise. And here's some proof. So I've gone on about the sales volume opportunity in the long tail. The long tail item sales opportunity can be seen here. This is taken from one of our clients that we recently ran long tail analysis on. The pink demonstrates the control group that did not see product recommendations. You can see that 16.8% of SKUs accounted for 80% of sales in the control group. When you compare that to the line in blue, 33.6% of SKUs made up 80% of sales. And we drove a 23.41% increase in sales. So it's not just about facilitating long tails, but it's about using the appropriate technology to enable intelligent filtering of items on site. If you have 1 million different customers, you need 1 million different websites. And that's the sort of thing that you can achieve with this technology. On the left-hand side, you've got 3 boots. On the right-hand side, you've got 3 boots. But you'll notice that the circles around those on the left-hand side are calculating the number of page views. Where there is overlap shows where customers looked at more than one item. That overlap is something that you are able to score. And this is called collaborative filtering. Collaborative filtering powers item similarity on Amazon, on platforms such as Spotify, Netflix. Amazon attribute 35% of their retail revenue to it. 75% of what gets watched on Netflix is attributed to this. It's all about understanding through behavioral data what the overlap is or the extent of the overlap to identify how similar 2 items are to one another. However, when you don't have lots of behavioral data, which can obviously happen when you add new items to a website for the first time, you have to depend on attribute-based algorithms. And this is where natural language processing, so men's trekking Gore-Tex boot, men's walking ankle support boot, men's boot hiking leather sole support, you can start to identify similarity in the names, categories, product descriptions, product reviews. And for visual items, such as fashion, furniture, we can also use computer vision to score similarity between items. And this is particularly important during COVID, where supply chains are uncertain and specific items are regularly going out of stock, to help people discover suitable similar item alternatives. Using that logic for item similarity or items that are compatible with one another, we can then also build a sort of relevant product universe for each individual customer. My comment earlier on, if you have 1 million customers, you need 1 million different websites. Well, this is the technology that can help you achieve that. It is, in a sense, a customer is their recent clicktail. The items that they have most recently engaged with are a good indication of their taste or their focus, and we can understand through the relationships of other items to those items what are relevant products to surface to them. And we can also use boost and bury functionality to meet specific business goals. What do I mean by business goals? Well, one issue at the moment for many retailers will be cash. If a retailer is looking to get rid of high margin items or overstocked items, then we can boost specifically those items in product recommendations. So you retain relevancy, but you give increased exposure to items that the retailer wants to get rid of. Another application is through sponsored slots. Certain vendors or brands may wish to actually pay for increased exposure on a website, turning a technology like this into a cash flow positive system for those retailers. They can charge on a cost per click basis or a cost per impression basis for sponsored items that are surfaced to customers. And finally, don't forget innovative approaches to search either. Keyword search is often insufficient, especially for visual items like this. Here's a video of me standing in Heathrow Airport before lockdowns began. I took a picture of that bikini on Accessorize, and here's our client at Spell Designs. You can see with these white hotspots that we've run an object detection algorithm, and now we're showing similar items available on the website. So to conclude, make everything available, get smart on pricing, and help me find it. Think about your search and merch technologies. Increase your chances of conversion through and acquire market share. Tiered pricing strategies and recommendation engines can drive customers to products they may not have found otherwise. And inventory optimization is necessary to thrive in a post-COVID world through both understanding what you need to stock and how much of you need where. Meet customer needs to filter investment decisions. Reduce spending on physical assets and manual activities. Increase spending on R&D and marketing. And here's a sort of zoom out of our entire system. So we were initially specialists in search and merch. The 3 core areas of our sort of tech stack include the collaborative filtering, the behavioral data, computer vision, and natural language processing. Our dynamic pricing technologies combine a mixture of intelligent margin optimization and competitor price scraping. Our inventory optimization products allow for allocation, localization, and liquidation of unwanted stock. And finally, our assortment intelligence system uses our computer vision and natural language processing to identify trend analysis that can help with your design and buying teams. Might sound like a lot of work, but it really isn't. There's a tracking tag that goes onto the website so that you can start to track behavior. Then you need to be able to provide a feed to allow us to process item attributes, but we can also collect those with the tag on site. We then want to ingest your inventory data. And if applicable, if you have multiple stores or multiple distribution centers, we can begin to localize that data too. Then we want to be able to layer contextual information to your shoppers. Personalization, similar item discovery, dynamic pricing. We then want to help you meet your business goals through boost and bury functionality, sponsored slots, floating or boosting overstocked items, or high margin items, depending on what you'd like to do. Then it's all about how we can architect inventory intelligence to set up reporting and key action notifications that let you know when you are overstocked or understocked in certain items and where you need to reallocate stock. Any questions? Okay. Couple of questions are coming. Integration costs, not applicable to the recommendation software. It's all done on the CPA model through Rakuten. The inventory optimization tools require a bit of scope, so it would be good to have that conversation. And then on the case studies, your name has come up as anonymous, but yes, we have lots of case studies that we can share as well.
Okay, cool. Yeah, so anyone, please, you can just jump onto Slido and submit questions. The details are just down the bottom of the screen here, and I also pop them in chat, or feel free to just pop questions in the chat down the bottom here on Zoom, that's fine, or speak up. Has there been any more come through? I'll just wait for anyone to put through questions, or if anyone wants to jump through and ask. But yeah, I was actually going to ask about case studies as well, James, so I can follow up after this with them.
Yep.
But yeah, as always, I will follow up with a recording of this webinar and also contacts for everyone at particular audience so they can reach out and ask any questions. Or if you have any questions, please feel free to reach out to me or even your dedicated account manager at Rakuten for any retailers and brands. I will just check here.
Just have one more question coming.
Grab that.
What do we need from a brand in order to work with them? So at a minimum, it's just the tracking tag on the website. That actually allows us to pick up all of the metadata, behavioral data, and to inject any kind of change to the customer experience of the website. Companies that, or retailers that do have a Google shopping feed or an equivalent are very helpful for our natural language processing and computer vision models. So for example, if a client was looking for visual search functionality, we would need to have the Google shopping feed. Yeah. My email is james@particularaudience.com. I think that Rihanna will probably share that around with everybody as well. But feel free to shoot across further questions and we can just go back and forth on email.
Yeah, okay. Great, well, if there's no further questions, we might wrap it up there. But like I said, I'll send it around and then anyone can get in touch and ask questions if anything comes to mind afterwards. But thank you again, everyone, for joining. And thank you very much to James. I think there's lots of great information in there and also opportunities for retailers and brands to really think about in this time. But yeah, any other questions, I'll send over details and you can ask there. But thank you, everyone.
Awesome. Thanks for having me. Thanks, Brian. Cheers.
Bye.